Today is Jobs Friday. South of the border, the U.S. economy adding more jobs than expected. The unemployment rate unexpectedly ticking lower to 3.7%. That is the lowest that we have seen this summer. Initially, we saw markets under pressure, concern that, okay, maybe this resilient picture is actually bad because it means the Fed won't lower rates. They've decided that good economic news is probably good news for the stock market. Let's bring in Chris Kerlow, portfolio manager at Canaccord Genuity's team LWC. Chris, thank you so much for being with us. How are you thinking about what the recent set of data is doing to market expectations that we're going to start to see those rate cuts flow through next year?
I think it shows that the Bank of Canada and Fed have done their job with what they tried to accomplish with the rate hikes last year. Forward expectations for earnings next year are at a record high. And I think we saw a lot of companies guiding lower coming into this earnings season. So if we can set up for beats on those record high expectations, as well as the Fed and the Bank of Canada leading towards rate hikes at the end of the year, it could be a Goldilocks scenario for both the bond market and the equity market.
So that's where the pushback is. Those expectations are out of touch with reality and need to come down. What do you say?
The expectations for which side? On the
profit expectations, yeah.
Yeah, so profit expectations, in our opinion, were guided lower. I mean, it's a sector by sector evaluation, but we think in aggregate we'll see better than expected earnings in 2024. Companies were quite cautious, particularly in some of the banking sector. I mean, you just reported Canadian Western Bank loan loss provisions easing, and we saw that across the Canadian banking sector. But those loan loss provisions are setting up for a pretty harsh landing on the economic side. And with the data you saw come out of the United States today, it's showing contradictory results. 3.7% unemployment is near record lows, and really setting up for a strong 2024.
So let's talk about those bank stocks. What did you glean from the set of bank earnings that we got? Where did you find comfort? Where did you find unease?
So we're still probably most cautious about the negatively amortizing mortgages here domestically in Canada. We've become more sanguine, going from neutral to slightly overweight, adding BMO following their earnings report. The results out of their U.S. division were very strong, with about 45% revenue growth, 44% net interest margin expansion. On top of that, we saw a pickup in capital markets activity. We added Goldman Sachs earlier this year, and we think that capital markets activity is just getting started and a leading indicator for things to come.
Are you buying into any of these Canadian-focused banks that have run up so much? I mentioned the best performing banks are the ones that are the most domestic in focus.
Yeah, I mean, we're buy low, sell high investors. Adding BMO likely, or because of its U.S. exposure, strong capital markets business. We actually are owners of TD and BNS. Obviously, BNS has been the laggard of the bunch with its international exposure. But we think that the Canadian Laurentians and Nationals are probably an area that we're kind of not as excited about from a valuation standpoint. We see a lot more value, those with the international focus and capital markets exposure.
On BNS, on Scotiabank, there's a pretty important investor day coming up on December 13th, where there's an expectation of laying out kind of a strategy of how to go forward from here. What are you looking to hear?
We're expecting that to be a pivotal day, and I think a bit more focus on curtailing some of the investments overseas that have kind of been a drag on net operating income. Their credit loan loss provisions will be of focus as well. They've done a lot already on the headcount reductions and cost reductions, so I think that I would expect them to kind of flatline on that side, and then really just lay out the strategy for growth going forward, and hopefully right the ship and take the lead going into 2024 during what we see as maybe some more economic weakness, but the stock market's leading economic indicator, and we think should drive things higher.
You mentioned the kind of buy low, sell high strategy. One of the sectors, and the banks fall into this bucket, that have done particularly poorly has been anything with a kind of high dividend yield, mainly because you can get that in the bond market. Are you picking away at those opportunities? We have seen this, over the past couple of trading sessions, some of those more bond proxy names perking up.
Yeah, I mean, we've been reducing cash since October, again in November. And like my golf coach said this week, take aggressive swings at conservative targets. And that's what you're looking at with those type of bond proxies. As well on the bond side, we've been minimizing credit exposure in favor of government bonds. Another example of that. We own some REITs and utilities, and we've also repatriated some U.S. funds into our growth names back here to Canada, actually, where we see an opportunity in a risk-on environment for the Canadian dollar to pick up against the greenback, and then those stocks to kind of hopefully lead going into 2024 versus what we saw with the Magnificent Seven this year stateside.
You think the TSX will outperform next year?
We're betting on it. We've been repatriating assets here, at 22 times forward earnings, trailing earnings, 20 times forward earnings on the S&P 500. It's not bad, but it's not nearly as attractive as some of those sectors that you just mentioned, trading at single-digit earning multiples. Obviously, increasing bond yields weighed on the debt loads necessary to operate those businesses. So if we do see a Fed pivot or a Bank of Canada pivot, even a pause here for an extended period of time, it should be a boon for those sectors, which the TSX is heavily weighted in.
Yeah, we have seen gold move up, which is obviously significant for our index. Are you picking away at some of these gold miners that haven't really kept pace with the price of bullion?
Yeah, I was going to say that we do see gold as a sector we like, breaking above 2,000 near all-time highs here. It really does provide a degree of operating leverage. We're owners of Barrick. They're one of the lowest cost producers in the world, weighed on a little bit by their copper exposure and demand concerns surrounding a potential recession, obviously globally. But we think that if you are looking for gold exposure, and do recommend at least some position in a gold, either ETF or miners. And we think right now, to your point, with the miners not keeping up with this rally, it presents the better opportunity.
Every time I ask Mark Bristow about Bitcoin, he sort of is like, forget about Bitcoin. It's still gold. What about you? Is it gold all the way, or are you putting in some crypto exposure?
We added some more Bitcoin exposure at the end of September. We think, we're privileged here in Canada to have a very stable currency. But if you're in a part of the world that doesn't have that opportunity, the American dream kind of faded this year as you saw your currency devaluation. So it's a great store of value. We've seen M3 expanding in the United States. It just makes sense that if there are more dollars and less Bitcoin, that you're going to need more dollars per Bitcoin. And then with the ETF launches coming up in a halving, there is an opportunity for it to run. And last but not least, it's such a retail heavy focused asset class that buying goes buying. And so we're likely going to have to rebalance at some point because of the velocity of the move higher. And we don't want to be the ones left holding the bag, but there's probably more room to run. And I think it does provide an area of diversification in a portfolio.